6 undervalued dividend stocks near their 52-week lows. Today's episode, every single stock has a minimum 20% upside. As always, we'll look at their historical performance, we'll discuss their dividend safety, we'll look at their financial metrics, their free cash flows, their debt levels, and as always, we'll run them through the valuation model, getting to the intrinsic value, acceptable buy price whilst incorporating our margin of safety, and look exactly at what Wall Street are targeting over the next 12 months. So let's jump into stock number 1, which is Humana Inc. Now this is down 31% over the last 12 months, pretty much trading bang on at that 52-week low. It does offer a forward yield of 1.04% and currently has a forward PE of 21.07. Now, if you've been holding this over the last 10 years, you would be up 210%. Remember, for those newer viewers, this doesn't incorporate if you were reinvesting those dividends. It would then be higher. And we can see all-time highs, October 2022, $555, so it is some way away. In terms of dividend safety, well, the highest score obtainable, very safe, 99 score. Market cap, 41 billion. It is a large cap company. In terms of those key recessionary metrics, well, no dividend was paid, so no comparative data. Plus 6% recession sales, above the average growth. Remember, S&P growth during that period was negative 12%, but they did significantly underperform the S&P, negative 72 versus the S&P's negative 55. Dividend growth, well, we're still waiting on an increase as they haven't increased it just yet, so hopefully over the next few weeks we will hear about that. Double-digit increase over the last 5 years, a double-digit increase over the last 10 years, looking very strong. And we can see they have been increasing those dividends for the last 12 years. In terms of dividend yield theory, now this is just for those that are new. It states the company is undervalued when that current yield sits above the 5-year average. So we have our first sign of undervaluation here, 1.04 versus the rolling 5-year average of 0.68. And then when we look on the forward PE, 21.1, it is slightly higher than the 5-year of 18.6. So although we do have a signal for undervaluation, bear in mind we're not looking at any of these in isolation. And we do note the healthcare sector PE is sitting lower at 17.2. In terms of the essential payout ratios, as always, free cash flow payout, we want to see below 60%. My personal blanket rule, just because it gives me faith that management are able to offer those double-digit increases we love to see. 2021, 39%. Since then, it has come down 15% in 2023, 18% expected in 2024. So we can see so far, while that dividend does have that very safe score of 99. Free cash flow per share, over the longer term, it has increased by more than 3 times, $7 to $24 in the more recent year. As you can see, though, very inconsistent, some years of extreme growth, followed by years where it does decrease. But if this is one you have been holding over the longer term, moving in the right direction. Although we do want to point out, 2024, we are expecting to see a decrease to that free cash flow per share. Sales growth, for those that are new, we want steady, moderate growth for all of the companies we're looking at, 3 to 7%. Nice to note for Humana, over the last few years, strong double-digit growth. So this is a very nice company. It is growing at a very strong rate, and so far the metrics do look favorably. 48.5 billion in terms of the top line in 2014, 106 in 2023, so more than double the growth over the period. And for more positive news, they do return that excess cash to investors. Share buybacks over the period, not massively consistent or essentially a lot, but still, nonetheless, this is a bonus from 156 million to 124. Then when we take a look at the ROIC, remember we do want to see at least 10%, or that is my personal target. That kind of gives me faith that management are able to effectively allocate their capital. Pretty much above 10% nearly every single year. The last 2 years, 16%, looking very solid as metrics go. In terms of the operating and free cash flow margin, they do leave a little bit to be desired. We want to see above 12% on the operating side, above 5% on the free cash flow. So something just to consider when you're looking at that margin of safety level that we'll talk about shortly. It is below that consistently, 4% in 2023. Likewise with the free cash flow margin, it does look like we would like to see this a little bit higher. Net debt to EBITDA, though, a fantastic metric. Earnings before interest, tax, depreciation, amortization shows us the dividend safety, or correlates to that in essence. as well as the balance sheet strength 0, 0, 0, 0, 0 in every single year, showing us that it wouldn't even take them one day to pay off all of their debt net of cash on hand. A very strong balance sheet from Humana. So a few things there to digest and think about. Let's jump into the valuation model. And as always, if you do enjoy this type of content, do smash that like button, do hit that subscribe and bell button. It really helps this channel grow, shows that you like this content, and I will continue to bring out more of the same. So in terms of the model, typically on the channel we do deep dives, we run through every single one of these models. For these kind of episodes, we jump straight into this intrinsic value, and for today's episode of Humana, we get to a price of $425. Now, with the current price sitting much lower, we do use that margin of safety level, starting off with 10%, which we use if it hits 3 criteria: wide moat, strong financial metrics, and good forward-looking data. So if you believe that for Humana Inc., you would be looking at a buy up to 383, and then we keep going till it's near that current trading price. And we can see for today's episode, it isn't at that 25%. In fact, it is pretty much bang on right now, a 20% margin of safety. In my opinion, looking like a fairly decent buy. But again, you do need to weigh up the risks as well as the regulations, whether or not this is one you do want to add to the portfolio or even just have it on the watch list. In terms of Wall Street, well, as I mentioned, all the stocks today have a minimum of 20% upside. We can see they expect 27% upside over the next 12 months. Their price target is $430, so they do see this as a very strong buy now, or something at least at the bare minimum to consider for the portfolio. Now, before we jump to the next stock, just to let you know, we have released the latest free weekly article. If you want to gain access to this or any of the other articles we have produced, all completely free, click on that pinned comment below and you get access straight away. Next company we're looking at is Vici Properties, down 14% over the last 12 months. If this is one you have, however, been holding over the last 5 years, you would be up around 38%. Again, doesn't include those dividends reinvested. We do see it towards the lower end of the 52-week range, with a yield under 6%, currently at that 5.7 level, and a P to FFO looking at 11.22. Now, this is one that has a 50 dividend safety score, borderline safe, which we'll touch upon looking at those metrics. Market cap 30.4 billion, a large cap company. We can see that the dividend growth is looking pretty strong, 6.4% increase last September, 10% on average over the last 5 years, double-digit growth, something we do love to see alongside a fairly high starting yield at 5.7%. Now, they have also been increasing those dividends for the last 5 years. In terms of dividend yield theory, well, we have that double sign of undervaluation, 5.7 versus 5.03. The forward P to FFO looking pretty attractive at that 12.9 versus that 5-year rolling of 14.8. And we do note it is lower than the real estate sector P of 13.7. Now, for REITs, whilst we do typically look at the free cash flow payout for other companies, it is essentially a lot more volatile for real estate investment trusts, so we draw your attention to the AFFO, adjusted funds from operation. Below 75% for the hotel REITs is the specification, and in fact, this is the target that Vici Properties have themselves hit, around 75% continually year on year. Nearly hit that every single year, 75 in 2023, 74 in 2024. So again, we can see there is no real worry with that dividend so far based on this information. AFFO per share will increasing every single year, moving in that right direction. 2024 expected to be more of the same at that 225 level. Now, it is important when you do look at REITs to also factor in the AFFO per share growth. Regardless of how much they are diluting your position, you want to ensure that they are growing at a very decent rate. 2023, 11%, very strong double-digit growth. 2024 expected 4%, on the lower level of what we'd like to see. Nonetheless, still looking fairly positive. On the sales growth, steady moderate growth for REITs, this is more around 5 to 10%. And over the last 5 years, or 4 years in fact, we are seeing strong double-digit growth to that top line. Numerically, again, for those that love the numbers, around 200 million to 3.61 billion. Now, as I mentioned, with REITs, they do typically dilute your position over the longer term, some faster than others. The key point here is to understand and check that the adjusted funds from operation is growing at also a very strong rate. Otherwise, they are diluting your position, which isn't really what you want to see from any company, regardless of a REIT or not. ROIC then for REITs 3 to 5%, other companies 10%, looking pretty strong over the period, 8% in the more recent year, looking much better than that minimum level that we're looking for. Operating margin as well looking very healthy, 92% in the last year. In fact, over the last 6 years, looking very strong, around that 60 to 90% level. Although inconsistent, regardless, even the lower level is still looking very healthy. Now, this is where we factor in that dividend safety, which is why we see that borderline safe. What this is essentially showing us is those number of years that it would take them to pay off all of their debt net of cash on hand. And for hotel REITs, we do want to see ideally a minimum, or in fact a maximum here of 3.5. 2023, 5.86. Now, this is well above what we want to see. 2024 it is expected to come down, but realistically until this around that 3.5 level, that dividend safety score won't be obtaining that safe or very safe score just yet. So something just to keep an eye on, but no real red flags based on this information that we have seen and analysed so far. So in terms of the valuation for Vici Properties, let's jump into that right now. And we can see for today's episode, the price is arriving at around $38. Don't forget you can grab a copy of this valuation model if you want to get to the intrinsic value as well as the acceptable buy price of companies in your own portfolio and in your watch list. Margin of safety then 10%, we can see it buy up to $34.59. We keep going, remember, so 15% still looking like a buy now, 20% at the current price, and 25% we can see, in fact, not too far off, around 7 cents. So right now we would argue Vici Properties has around that 25% margin of safety. This is one that I have been adding to more recently over the last few weeks as well. In terms of Wall Street and their forecast, while they see upside of 24%, they have their price target of $36 over the next 12 months. And as always, let us know in the comments as we go along with these stocks whether or not you have been adding any of these, or for whatever reason they're on your watch list, or they're not something you are looking at buying for now and you have a bearish stance on them. The next stock that we are taking a look at is ALB, Albemarle Corporation. Now this is down 53% over the last 12 months. Again, right there at their 52-week lows with a forward yield of 1.35% and a forward PE of below 30. Now over the last 10 years, they are still up around 93%, and we do see their all-time highs sitting around $325 in November 2022. Now, even though they have dropped dramatically, their dividend safety still sits very safe, a score of 90, market cap 14 billion. We are talking about a large cap company. So those recessionary metrics, they increased the dividend during the last recession. They had below average growth, and they also slightly trailed the S&P with their negative 63% return. Now again, we are still waiting on a dividend increase. Over the last 5 years, they have increased it on average by 4%, which remember, we advocate on this channel that minimum of 4%, whether it's your salary, your dividends, your other income producing assets, just to keep up in line with inflation, because the US inflation rate over the last 40 years was 4%. So anything less, you are essentially taking a pay cut and losing your purchasing power. Last 20 years, 9%, so that is quite nice to know, and we can see they are a dividend aristocrat. They have been increasing those dividends for the last 25 years or more. Now, in terms of dividend yield theory, we can see the undervaluation signal. The yield is above the 5-year average, although we do know the forward PE is sitting much higher than that rolling of 15.2, and we can see, in fact, in 2022, it went as high as around 70 on the forward PE. In terms of comparing it to the materials, we see that at 19.1, so Albemarle does currently sit significantly higher at 31. In terms of the free cash flow payout, well, we can see it is looking very volatile on here. And the reason for this, as we're about to see, is they have had negative free cash flow for quite a number of years. 2022 at 29%, 2023 at negative 23%, something just to consider. So we can see it's gone from 485 in 2014 to 552 in 2022. 2023, however, the more recent year, negative $7. 2024 expected to pick up significantly, but still negative at 237. So sales growth we can see here looking fairly positive over the longer term. We can see 2023 double-digit growth, 2022 triple-digit growth, and before then, still looking pretty decent. We can note 2 years of negative growth, but otherwise looking pretty strong over that long-term horizon. And we can see they have increased their top line from 2.45 billion to 9.62 in 2023. Now, they have diluted your position over the longer term, increasing those shares outstanding from 79 million to 118. In terms of the ROIC, remember 10% or more, which was pretty strong if we were looking at 2022. Unfortunately, it did dip in 2023 to 3%, so something just to consider. A few metrics to digest, whether or not, one, this is the company for you, and two, what your margin of safety would be. Operating margin as well, it did drop significantly, even though we did see that top line increase double digits around 31%. So it is at that 5% level. And the free cash flow margin, as we noted from the free cash flow per share, is looking pretty volatile and inconsistent. Net debt to EBITDA though, 1.03 in 2023, looking strong given the maximum we want for these type of companies is 3. Although what we can see here is in 2024 it is expected to increase quite significantly, but below that 3 nonetheless. So in terms of the valuation for ALB for today's episode, we can take a look and see what we have arrived at, which comes to $168. Now current price at $118, we start off 10% a buy up to 151. At 20%, a buy up to 134. At 30%, we can see pretty much again similar to the previous company we analysed and not too far off, under $1. So we see a 30% margin of safety. So remember, this does come down to what level of MOS you are looking for. Firstly, whether this is a company that interests you. Secondly, if it is, what level of risk you are looking to take. In terms of Wall Street and their forecast, well, they see 35% over the next 12 months. Their price target is $160, so they do see this as a very, very strong buy now. And as always, do let us know your thoughts in the comments below. The next company we're taking a look at is United Health Group. Now, this is up around 1% over the last year. Over the last 10 years, however, up a very strong 530%. We can see its all-time high sitting in the 52-week range of $555, and it does have a forward yield of 1.6% and a forward P of around 17. Now, dividend safety score 99, the highest score obtainable. Market cap 439 billion, a mega cap company. Now, they maintained the dividend in the last recession. They didn't cut it, but they also didn't increase it. Above average growth, and again, marginally trailed the S&P with their negative 63% return. Lots to love about their dividend. Double-digit growth last summer, double-digit growth over the last 5 years, 41% over the last 20 years. So a strong dividend growth company. And they have been increasing those dividends for the last 14 years, whilst paying a dividend for the last 31. In terms of dividend yield theory, well, we can see a double sign of undervaluation, 1.58 versus 1.43, and the forward PE 17 versus that 5-year average of 19.9. It is also pretty much bang in line with the healthcare sector PE. Free cash flow payout, lots to love. In fact, over the last 10 years, below 30% every single year. 26 in the more recent year, 24 expected in 2024. So again, this is one that I would be surprised if we don't see a double-digit increase for UNH investors. So free cash flow per share, again, whilst it's not consistent every single year, over the longer term, looking pretty solid, or as consistent as maybe one could look for. 27.70 in 2023, expected to go even higher in 2024. And in fact, in terms of consistency, the only real company that I have analysed on this channel for consistent every single year growth to the free cash flow has been Broadcom, which we did review yesterday. Sales growth looking positive, double-digit growth over the last 3 years, and in fact, over the longer term, still beating around that 3 to 7% minimum we target. So looking like a very strong company in terms of growth to their top line. And we can see they've nearly tripled their top line, 130 billion in 2014, 372 in 2023. Now, they do share buybacks, but very minimally and not that consistent. In fact, we do see a period here where they issued shares, so they would have diluted your position. But if you've been a shareholder since 2014, the net position would be a share buyback. So, okay, nothing really to discuss there. Consistency on a strong metric is what I love to see. Pretty much 19% nearly every single year over the last 10 years. So looking very, very healthy for this metric. Operating margin and free cash flow. Remember, above 12% the preference for the majority of companies. It has been increasing from the 8 to 7 we saw at the back end of the last 10 years, but still at that 9% level, I would like to see at a minimum 10 to 11% over the next few years. Not the worst, not a red flag indicator, but just something to monitor. Free cash flow margin looking nice and healthy over the last 10 years. Net debt to EBITDA, I love to see this, is essentially decreasing, and it was already pretty low in 2015, 1 in 2023, 0.91 expected in 2024, so no worries to the dividend, no worries to the balance sheet so far and based on this information. So let's get to the valuation of UNH. Now for today's episode, this value is arriving at $583. Now with a current price of $477, that margin of safety of 10% means a buy up to $524. At 15%, $495, and at 20%, not quite there yet. So it's currently sitting between a 15 to 20% margin. Now, in my opinion, this is a very high quality company. There have been some issues, regulatory issues, in fact, over the last few weeks, which we have seen that price drop. This is one that I have been buying, and at a 15 to 20% margin of safety, for me, again, this is one I am satisfied with. In terms of Wall Street, 24% upside over the next 12 months. They have a price forecast of $591, so we can see they are expecting more than $100 per share growth for UNH. This then leads us to the next stock, which we have as Rio Tinto, one we actually haven't reviewed in quite some time on the channel. It is down around 12.5% over the last year. Over the last 10 years, however, whilst it is up around 34%, we can see all-time highs 2021 sitting around that $85 to $90 level. It does, however, have a forward yield of 8.23% and a forward PE sitting around 7, but do bear in mind this is a company that does operate in a cyclical industry. So we have a dividend safety score 40 unsafe. Again, we'll look at those metrics. Market cap 108 billion. It is a mega cap company. Key recessionary metrics, well, they cut the dividend during the last recession, below average growth, and also trailed the S&P. We can also note they did have a negative, or in fact a dividend cut last year. However, over the last 5 years and over the last 20 years, dividend growth has been fairly decent, but again, do bear that in mind. So we can see they have 0 years of consecutive increases. In terms of dividend yield theory, well, we can see here some slight signs of undervaluation of 6.92 on the yield versus that 5-year average, and on the forward PE 6.9 below that 5-year average. But remember, none of these models are to be looked at in isolation. We can also see the materials sector PE much higher at 19.1. So in terms of the free cash flow payout, again, this is a mining company, so we can look industry specific at 40%. Something to bear in mind, the last few years have been in the mid to high 80s, but still it really does depend on your own preference to what free cash flow payout metric you want to use. So we can see that is one part of why we see that borderline safety score on the dividend, but do also bear in mind that this company did already reduce their dividend. Free cash flow per share has increased over the longer term marginally and very inconsistently. Something else to point out is from 2024 it is expected to be pretty flat to 2023. So in terms of sales growth, we can see again, remember the industry it does operate in, it is cyclical. And one thing I would say when analysing cyclical companies, you do want to try and buy these or pick these companies up when they are out of favour, when nobody wants them. And that is generally the cheap price to buy them, and then ride them into when they become in favour and in cycle. So we can see 5 of the last 10 years, so half of the last 10 years, in fact, they have had negative growth. More recent year, negative 3% to their top line. It has gone from 48 billion to 54 in 2023. They have also done share buybacks, reducing these share counts, but we can note from 2020 it hasn't moved, so it is very inconsistent. So I wouldn't rely on this if you were a shareholder or incorporating this into your investment thesis. Now, in terms of the ROIC, looking pretty solid in all fairness. I mean, above 8% for mining companies the last 2 years in the 20s, before that in 40% territory. So it is looking pretty strong as a metric. We can see that management do look to be doing a fair job. But again, there are other things to consider before concluding on management. Operating margin, very solid for a mining company, well above 12% every single year, and the free cash flow as well. So yes, there are some negative metrics to consider, but there are also some very positive ones. And in fact, what we can see from here on the net debt to EBITDA, 0.25 in 2023, 0.23 in 2024 expected. So I would say, whilst there are some concerns around that dividend, their balance sheet does look pretty healthy, and if they can keep that free cash flow payout under control, then the dividend should be safe. But remember, this is purely based on the information we have today. So in terms of the valuation, let's get to it. What is it looking like? Are there any signs of undervaluation? Our intrinsic value comes at just under $80. Now, with the current price of $63, that 10% margin is a buy up to $72. 15% $68, 20% $63, so it isn't too far off that, so it wouldn't yield a 25% margin of safety. So for today's episode of Rio Tinto, we see around 20 to 25% margin. In terms of Wall Street and what they forecast, well, upside of 31%, they see some very strong upside, in fact, for Rio Tinto, a price target of $82. And as we can see, not only is there some strong upside to the current trading price, but they also are locking in, or you would in fact be locking in, a very strong yield of above 8%. But again, there are some other factors to consider. Now, the final thing to note just before we jump into that last stock is also that with Wall Street's forecast, always take it with a pinch of salt, always do your own due diligence, because when companies increase in share price, they will revise their forecast upwards, and the same goes for if it is going down. So final company, C.H. Robinson Worldwide. Now they are down 30% over the last year. Over the last 10 years, however, you would be up 42%. All-time highs not too long ago at $117. Again, trading right there at their 52-week low. Yield of 3.4% and a forward P of 22.4. Dividend safety score 80, it is safe. Market cap 8.5 billion, it is a mid-cap company. Key recessionary metrics, well, pretty positive. They increased the dividend during the last recession. They had average growth, and they also significantly outperformed the S&P with their negative 27% return. We're still waiting on a dividend increase from them. The last 5 years on average above that 4% we advocate to keep up in line with inflation. Last 20 years pretty healthy, 14% double-digit growth, and we can see they are a dividend aristocrat. They have increased those dividends for the last 26 years. So we have that yield sign here now showing undervaluation, 3.37 versus that 5-year average. We do note, however, the forward P is sitting slightly higher at 22.5 and also slightly higher than the industrial sector PE. In terms of the free cash flow payout, now remember, we haven't covered this yet, but we do always focus on the free cash flow as the earnings are susceptible to manipulation by management through accounting. One way to show this is in 2021, what we would look at here would we see 33%, we'd be happy. What this essentially signifies is that management paid out more in dividends than they generated in free cash flow. A little bit of a red flag indicator, but since then it has come down. The more recent year, 45% looking pretty strong. Next year looking around 59%. Again, no real cause for concern so far. Free cash flow per share, $3.29 in 2014, $5.46, so it has increased. Very, very inconsistent though, and also point out here that 2024 is expected to fall. Sales growth then, we can see negative 29% in the more recent year, but prior to that, again, pretty inconsistent, but not looking the worst, not looking the best, somewhere in between. And we can see numerically it has increased from 14 billion to around 18 in 2023. Also done share buybacks similar to the majority of the companies we've analysed today, 120 million in the more recent year. So looking at the ROIC, even though it has decreased over the last 10 years, 16% is still very strong. Now, whilst we don't like a decreasing pattern on any metric, something just to keep an eye out on, but still 16% looking healthy as these metrics go. Operating margin, now this does give a bit of cause for concern, 6% down to 3% in 2023. I would say this is definitely one to keep an eye on if you are an investor or a potential investor. The smaller this goes, the smaller that bottom line net income will be. And the same could go for the free cash flow margin. So for C.H. Robinson, one thing I would point out is do keep an eye on those operating margins. Net debt to EBITDA, 2.38 in 2023. Now, whilst this isn't any cause for concern and is expected to be flat in 2024, do note it has increased from the last 10 years, but still it hasn't gone that much higher, and 3 is the maximum you want to see. So again, this isn't a red flag indicator, just a few pointers for this company if you are an investor or potential investor. So let's jump into this valuation, and don't forget, if you do enjoy this episode, smash that like button, hit that subscribe button so you are continually notified of these as they go. And don't forget, you can grab a copy of this valuation model to run your own companies through, those in your portfolio, or just to run through these again with your own metrics. So a 10% margin of safety, a buy up to $79. Then we look at 15%, $75, and at 20% we can see it isn't quite there yet. So for today's episode of CHRW, a 15% MOS level, or you could say 15 to 20. Wall Street, however, they're looking at a price target of 21% upside, $88 over the next 12 months. So similar to the other companies we have reviewed today, some very strong upsides, all that Wall Street considers to be strong buys with a minimum 20% upside across every single one. Let us know your thoughts in the comments. Are any of these attractive to you? Are any of these maybe you're adding onto your watch list? Or again, you may not like any of these for whatever reason. Let us know. Don't forget, if you enjoyed the episode, smash that like button. We'll see you all on the next one. And for now, take care.